Hey everybody, this is Jose Blasco. We are about to get started. Please sound check. As always, a quick message on the chat box, a quick hello will do. That way I know you hear me and we are ready to get started. Please go ahead and do that when you have a moment. In the meantime, I will just position myself in the bottom right portion of the screen as always. How are you everyone? Good to see you, my friends. So we are going to get started in 18 seconds. Christian, how are you? Nice to see you. Nice to see everyone. Very good. Almost ready to go here. That's it. 1 second to go. We are live, everybody. Welcome to the session, everyone. Today is June 9, 2021. This is Options with Options. Options give you options. We love it, isn't it? We're going to be looking at the markets, understanding the environment, putting the trades together, and enjoying the process of trading and having our trades develop and manage them during the life of, of those trades, etc., etc. Before we start, as always, I would like to highlight on the upper left the disclaimer. Please read it carefully. This is important information. Read it all, do not skip it, do not skip any sentence, any word, any paragraph. It is important indeed. So I'm counting on you to read it carefully. Thank you so much, guys. With that said, let's talk about the agenda for today, which is, just like trading, it's all about being mechanical and having a structure in place. So we do the same with the sessions, isn't it? So we just said hello. I wanted to remind you all that we are simulcasting. So depending if you are attending the session in our private room, located in our website, which is tradewithufos.com/live. I was saying, depending if you are there in the private room or you are in any other public spaces, just such as YouTube or Facebook. So of course the video lags are going to be different, and also depending on the countries and the locations and your internet provider and so on. So keep that in mind, that there will be for sure some sort of a delay between what's happening on the charts, for example, and what you see when you look at the session. Maybe a few seconds delay. Keep that in mind, as well as when you interact with the chat box. Okay. Apart from this, the other implication of simulcasting is that if you are in a public space, the duration of the sessions is going to be limited in time. Where if you are in our private room, then you access the full duration session. Okay. This is basically the way we have to accommodate, or adapt, maybe is a better word, to the two key groups in our community, which is some of you are looking at trading as a part-time thing. So then easy, just attend the session on YouTube or Facebook, and then it's free for you, even though it's limited in duration. If you are, I always say, like me, in the sense of very passionate about trading, never got enough, always want more. So then in the private room, you have full duration session, but that implies that you need to be subscribed as a coaching plan member, and you can find more information on our website. Okay. Joanne, how are you? It's good to see you. It's good to see everybody. And so let's begin. Okay. And the structure of the session is also, as always, going from, top to kind of like a top-down approach, if you wish. We're going to be looking at the markets. We're going to be looking at the trades that we have running. And from there, we'll be looking at new trades. So let's begin. Here's TradeStation. Here is the S&P. Little bit of a surprise there, or maybe not, depending on how you look at it. We are in an up climate. This is candle 13 out of what statistics would say 9 is a normal thing to happen. So in other words, we are beyond what's normal, and therefore we are now stepping into a territory where, we've seen markets, go crazy and remain crazy for a while. I'm not saying this is crazy, but definitely it's more than normal. Okay, it's beyond what normality would suggest based on statistics, and therefore this market is quite extended and should retrace based on statistics. Okay, having said all of that, look at how many green UFOs we find below price. So many green UFOs, and we are now stepping into the all-time high territory. And therefore we may have one of those situations where, from 13 candles, the market just go crazy for another 10, and next thing you know, we see 23, 25, on auto climate. which is not a normal thing. It is not supposed to happen based on probabilities, but it could. Okay, so we'll see what happens. In any case, this comment is not to get anyone greedy. Okay, I always talk about the importance of managing human emotions, so we never get greedy. Okay, and if we feel we are getting greedy, we healthily caress ourselves like this a little bit, maybe slap a little bit, something like that, just to wake up and be like, hey, what are you doing? Okay, we gotta act based on a plan. The plan needs to be emotionless. Okay. And the reality is that entering stocks when the S&P is suggesting this type of stretch already, basically it's putting you late to the party. Okay, so sometimes it may work, but most of the times it wouldn't based on probabilities, and therefore going long is certainly not the right choice at this moment in time. Last week we did. Okay, last week we did, and we'll review what's happening with Lily, which was one trade that we put in place precisely to take advantage of what just happened. Okay, so we'll see that in a minute. But doing the same trade that we did with Lily last week, doing it today, that would be erroneous because the S&P, statistically speaking, is too stretched. Okay, so it's better to wait for a retracement, which may imply some patience, and then do it later on instead of doing it now. It's too late. Okay. Now, from an implied volatility point of view, I'm loading the chart of VIX right now. And as we are loading the chart of VIX, we can see that implied volatility is 17.03. Okay, so it's kind of flat if you compare with yesterday. There is a green UFO that just showed up, meaning that, I guess that someone out there is buying options intensively, probably, a bit concerned that the market may fall. It will not be surprising, especially if people do a market analysis, an intelligent, data-driven type of market analysis. Statistics would show that the market is overstretched. Okay, and therefore there are some people buying some protective puts, which is the reason for the green UFO on the VIX, and a little bit of an increase in value. Okay, because it went as low a few days ago as 15 point something. That was the low of that week. That was 15.15 actually. Okay, so we are now trading at 17, which is certainly not that high, but is a bit higher than before. Okay, so now notice the red UFOs above. There are plenty of red UFOs above, and there are no green UFOs below. So again, it is more likely for the market to continue going higher than to fall. Having said that, it would be a very normal and very healthy thing to get to see the market retrace for 2-3 days, and from there begin making all-time high in a more healthy manner. Okay. So from an implied volatility point of view, of course, since I am expecting the market to go up more than to go down, I would expect therefore the volatility to fall more than to rally. And on top of that, we are just reacting to a green UFO, meaning volatility may go higher as we are in the session today. So in other words, when I get into looking for opportunities for non-directional trading, I will start the session looking for trades such as iron condors, which imply selling premium. Against again, I would expect that you are with me on the rationale on why I'm gonna start there. Also, because if I was to look at my portfolio, okay, I got TIM and MasterCard are iron condors, PayPal and AMD are double calendars. So in this sense, those two are positive Vega, those two are negative Vega. So I'm kind of flat Vega, okay. And therefore, if I choose to add something Vega, so then given my comments about the VIX, then I believe it's more intelligent to start the day with selling options than buying options. Okay, and then if we get one trade such as an iron condor, and now we are negative Vega again, then we'll be looking for the opposite. Okay, so we can keep offsetting our Vega on the portfolio as an overall exposure to changes of volatility. Okay. Cool. Okay, so with all of this in mind, let's review the trades that we have. We'll start with TIM. I will also bring Thinkorswim to the screen. Okay, so here is TIM. TIM is currently profiting by $175 per contract. Okay, the trades that we have so far are doing quite well. TIM is doing 175 at this moment in time. So if I expand it, notice that everything is June 18 expiration. Everything is June 18. In other words, we are talking about an iron condor and therefore what we want to see that stock do is to trade either up or down, but remain between 254 and 202, which is basically actually it's not 202, it's 187.8. okay, I believe. I don't think we did a roll on this one. Let me load AutoStation Pro so that way I say it right. We got 190, 190. Yes, yeah, we didn't do a roll. We didn't do the roll. I had that line there when I was explaining what you would need to do if that was to happen, but it never happened. Okay, got it. So anyway, so we are still in the original Iron Condor. Okay, everything is working according to plan. Our options 190 below, 260 above are decaying, and this is how the PNL of this trade shows 175. Okay, when we look at the values of the short units, you can see it's 12.5 and 17.5. When we sold them, we collected 2.8 and 135. So basically, those options are basically gone. They're basically dead. Okay, there is nothing else left. Okay. Yes, thank you for that, Maka. Thank you for for confirming what I just said. In so many trades that in the end, sometimes you rely on memory, and sometimes it's a good idea, sometimes not so good. So I wanted to double check. But I appreciate that you are working with me, on confirming that. That's very appreciated. So yeah, so those options have lost plenty of value. One option that some of you may consider is be like, okay, what about we close the trade and that's it, we're done. Okay, well, you could, because this is Lily, sorry for that. Let me load team. So you could close the trade, okay, but at the same time, because we're getting closer and closer to the expiration date, because team is not the most liquid stock in the S&P, and because some of those strikes are going to be far away from the current price, and that's why the premiums are so low, so you should expect a pretty bad slippage if you were to do that. Okay, so from 50 positive to 35 negative, okay, this is like $85 of potential slippage if you were to close the trade manually. Okay, so again, the idea is to try to avoid that if possible, okay, to not to get hurt on slippage. And therefore, since the trade is working so well so far, there's nothing to say. I mean, some of you may be like, wait a minute, Jose, the most we collected is 175. The credit we collected was 175, so the most we can make is 175. We are currently making 175, so why don't you close it? Okay, well, yeah, if you can close it, okay, if you can close it, at a perfect price, so then yes, you're gonna collect that. But the reality is that, as you can see here, with the bid price and the ask price, is that lots and lots of slippage is expected when exiting this trade, given the fact that strikes are so far away, and we are getting pretty close to the expiration date. And when that's the case, the very far out of the money options, they have very little liquidity because no one is trading them, since there is very limited time until they expire, and they are very far away. So it's not interesting to sell, and it's not interesting to buy either. Okay, unless you find someone willing to buy a lottery ticket. But smart traders would not do that. So in any case, the right action with team really is to do nothing, just to wait. Why? Because when we look at probabilities, you can see it shows 247 to 220. Okay, and when you look at the chart, so 247, it's more or less here. Okay, 247, 220, it's more or less here. Something like that, and therefore it does look like we are gonna end up in the purple area, and therefore there is nothing to be done, okay, so far. Okay, so we're gonna just leave it alone. We will review it again tomorrow. If you have any question, please go ahead and let me know that you have a question. And also, you guys on YouTube, you've been very quiet today, so just make sure you say hi, so I understand that you guys are with me and all is good. And also in the private room, guys, if even though I guess it's all clear with team because it's very simple, I would certainly like a confirmation that you guys are with me. So I'm gonna change symbol, but again, a quick yes, Jose, I'm with you with team, something like that. That would be appreciated. So moving to MasterCard. Okay, so what do we have with MasterCard? Well, if I start with TIM, and I look, sorry, not with TIM, if I go back to TOS, I meant to say, and I expand MasterCard, so we will see that this trade is also profitable at the moment, $61. We can also see this trade is made of June 18 expiration options, so it's also an iron condor. Okay. And when looking at the chart, we can see that we are clearly inside the purple area. And when we look at probabilities for MasterCard, probabilities suggest that the price is going to stay between 380 and 352. Okay, so 380 and 352, it's more or less here, something like that. And 36, what did I say? Sorry guys, I got confused for a minute. 52, I'm like, it cannot be 62. 52, which is more or less here, something like this, right? So in other words, price is currently 365. Based on those probabilities, we are supposed to stay within the range. It's looking like we're gonna stay within the range, and therefore nothing to be done with MasterCard. They are using the same expiration date, June 18. That will be next week on Friday, and therefore you know, it's looking good for the trade to fully expire with a full profit. Okay. Maka, if we had rolled the puts, that would have been a good idea. Well, yeah, after the fact, if you look at TIM and you see the stock went higher, and you know, the probabilities are making the dotted lines to be closer to each other as well, and all of this. So yeah, after the fact, you would know that rolling to higher puts would have worked better. You would have collected more premium, and you would have a more profitable trade. But at the same time, the question is, what's your triggering condition to roll the puts? Is it because, you know, that day you felt inspired to do it? And I know that's not you, Micah. I'm just making a generic comment. But, you know, is it that because that day, you know, you turn on the computer, you're like, oh, you know what, it looks like it's a good day to roll the puts? Or did you have specific rules to take that action? Okay. So, of course, my proposal to you, as you know, you've been attending the sessions for a long time with me, so you know it's all about being mechanical and rule-based. So you need to have rules that tell you when to roll the puts. And the rule that I've been introducing to you is when the dotted line surpasses the solid line. And when that's the case, then you know you are in danger on the upper side of the condor. So now it makes sense to bring in more premium by rolling the puts higher. Okay, so you do it only when danger is, is around. If there is no danger around, it's better to do nothing, because you will save some commissions, you will save some slippage, and also, let's face it, you know, you have this statistical range which is very wide when we start the trade. So if the market was to go high too much, right, which is, you know, not expected based on probabilities, and on top of that, even with the UFOs that we had to protect ourselves, price went through, right? So, well, this is telling you that probably the market is just, you know, moving very, very far. And very, very fast, right? And what happens typically when a market is moving very far, very fast? Well, it turns around and moves just as fast in the opposite direction, at least for a while. It's kind of action-reaction, right? So in other words, if you roll the puts too soon, right, you now may be in trouble because now you have puts that are too closer to price. So not touching the range, it's a better choice from a probability point of view, because you allow price to do crazy things and still end up with a profit for you. Crazy things moving up, crazy things moving down, and you still end up in a profit. When do you want to roll the puts? When you have danger in one side. Okay, because the moment you have danger in one side, then you have to do something about it. You don't want to just hope for the best. So then rolling, it's not a choice. Then rolling is a rule, because you have to do something to try to help the trade to be less painful, because it looks like at that time it's gonna statistically end up in the pain instead of in the profit. Okay, so again, long story short, have rules to have those decisions. Okay, and that's how you do it in a way that is safe. Okay, sounds good for Christian. Yep, all is good, wonderful. Perfect. Thank you so much, Mark. So anyway, MasterCard, nothing to be done. PayPal. Okay, let's take a look at PayPal. So when we look at PayPal, here we can see $69 of profit on PayPal. Okay. When we look at what we have 16th of July expiration combined with 11th of June expiration. Okay. So 11th of June is on Friday this week. Okay. 16th of July is gonna be much later in time, which is an obvious statement to make. Okay. So now, important for you to understand, even though here it shows 61, it doesn't mean we're making 61. We may be making more or less depending on prior losses collected on the trade, okay, or profits. Okay, so let's take a look at what happens if we look at TradesTation Pro with PayPal. Okay, so notice that here it says that the net P&L after all the tweaks that we have done to this trade is actually 113. So even though TOS is showing 61, actually we are up by $113 per contract on this trade. Okay, so it's actually better than what it looks like. Sometimes you're gonna be the opposite. Sometimes it will look very good on TOS, but then you come here and with the net accumulated tweaks that you have done since the trade exists, then actually you are in a worse position. Okay, in this case, it's a better position. Okay, good. So all of this is good. But now the question is, that stock is currently trading at 264. Okay, you probably remember that this is a double calendar that we have been tweaking already, I believe for 2 weeks or maybe 3. And every time we've done it, we've been working on that 260 call because, price was going higher, creating a little bit of pain to the 260 call that we sold. But at the same time, that option is collecting time decay. And there is a moment in time where, especially, in this case, it's going to be difficult because 264 is $4 in the money. But there were times where the option was trading at 260.5, 261 something, and when it was close to 260, okay, in any of those retracements to the downside, we were able to tweak the trade and roll it to the next expiration date because we got to see distorted wicks on the call, distorted Greeks on the call. So I don't think that today we'll be able to see distorted Greeks on the call because $4 in the money, it's a significant amount. Maybe I'm wrong. We're gonna check. But certainly the 230 puts, probably it's allowing us to roll it already. Okay, so let's go ahead and take a look at, we'll start with the put, 230 put, see what that put provides us with. Okay, so we have the 11th of June expiration. We are looking at the 230 put, okay, which is right here. This put has currently extrinsic value of 11 cents. And the theta value is 17. So in other words, the algo, the pricing model for options here is telling you that you're gonna make 17 cents a day for 2.5 days. This is 40 cents. But the most you can make is actually 11, which is the extrinsic value of the option. So in other words, we got distorted Greeks on the 230 put. Okay, therefore it's time to roll it to the same 230 put, but the one that trades on June 18. Okay, that's the one that we are going to be using. Okay, so let's begin with this first roll. That's an easy one. I'm just gonna do it here. So I'm gonna select the 230 put. I'm gonna right click to create a rolling order. Okay, waiting for data. Here we go, we have it. So sell one, and here you can see the result. So we are buying back the June 11 230 put and selling one of the June 18 same 230 strike put, and that will create 16 cents of credit if we get filled at the midpoint. Okay, so it's not a lot. Okay, of course that's the price to pay when price has moved a lot in the opposite direction. So the puts are cheap at the moment because price is higher, much higher. But that's what it is. Okay, it's definitely time to roll, and therefore we're gonna do it. Okay, so we're gonna roll it here. I'm just gonna give you let's say 10 more seconds just in case you want to take a screenshot or you want to double check what I'm about to do here. Okay, also to save a little bit of time, instead of 16, I'm just gonna ask for let's say 15 or something like that. You know what, just to try to get filled very quickly, I'm gonna use 13. So let's do this. Before you take the trade, I'm just gonna confirm and send. Typically I will get more than 13 because TOS, normally we get midfield at the midpoint. I just got 16, okay? As you can see on the upper left, I got 16. So, 16 is a good reference point for you guys to do the trade. If you guys want to start, let's say with 20 cents, remember the rolls is not something that you want to rush. I'm rushing it because I want the fills. So for educational purposes, I have it and then I can, talk about it and lead you and explain and demonstrate and all of it. But for you guys, there is no need to rush. So if you want to start with 20 or maybe 18, you can do that. And then if you don't get filled, you try 18, then you try 16, and hopefully you'll get filled at the price I got or better. Okay. So first thing that we have done here, it's to get filled at 16 with the roll. So let's simulate the roll. Okay, let's simulate the roll. So far we are in a trade where the cost of the trade is 705. Okay, so I'm going to duplicate this trade. Okay, so I just duplicated it. Okay, and what I did is the 230 put, I made it June 18, and because instead of 705, I just collected additional 16 cents, which is bringing the cost down to 689. Therefore, my new trade has a cost of 689. Okay, and with that in mind, okay, 689. So what I'm going to do now is I'm just going to kill the upper row and only leave the bottom row, which is the one that combines June 11 and June 18, which is what I just did. Okay, so this puts me in a position where I would be now currently up $100.49 net. Notice again, if I go back to TOS, now for PayPal, it shows I'm up 82. Okay, it shows more, it shows better P&L than before. It doesn't matter. Remember, this is just what's happening now in the account, but we have closed trades before. So if you add up the whole thing, it's $99 now as the price of the stock is moving. We are nicely positioned below the blue line, so great theta, $35 a day of time decay, so that's nice. And we know as well that the most you can lose is 689. Why? Because the cost of the trade is 689. So it's it's a little bit of a gain that we had there, tiny one, only 16 cents. Why? Because obviously that's what we got with the roll. But again, what's the beauty? We are very positively exposed to Vegas. So what happens if volatility as earnings approach rises by 5%? So automatically your $99 become $286. Okay, so again, this is, remember, don't forget that. Okay, this is not a directional trade. This is a volatility trade where we are playing the increase of value of options while price remains trading in some sort of a range. Okay, so this is the first thing that we have done, okay, with the 230 put. Now we would like to go ahead and look at the 260 call, which is in the money, which has an extrinsic value of the 95 right now. Let me freeze the screen. 89 as I just froze the screen. And notice that theta is 44. Okay, so 44 times 2.5, it's a bit more than 89, isn't it? So we got 2.5 days to go. So if I do the math, 44 now is 47 actually. So 47 times 2.5, this is kind of like $1.17. Okay, $1.17 is what you're gonna make based on theta, but extrinsic value is actually 102. So guess what? I was wrong. Actually, we got these distorted Greeks, and therefore it is time to roll. Okay, it is indeed time to roll this trade right now. So if we roll it using June 18, the 260 is gonna pay us 700. Okay, so take a look. So PayPal is here. I'm going to take the 260 call. Okay, I'm going to right click to roll it. Okay, and as I roll it here, okay, so I got +1, meaning I am buying to close the 11 of June 260 call. That one I would do it for a loss. But then I am selling the 18 of June 260 call, and that one I do it for a credit of 700. So altogether, it's a net credit of $200. Okay, and if I do get filled at that price, and again I'm gonna make it, let's say 195. Okay, so that way when I place the order, I will get filled easily and will get a reference. So I just place the order. So let's see if I get filled quickly. So I can show you that. Here we go. I got filled at 195 actually. Okay, so this is what I got. I got 195. So what happens now is that if I go back to the simulator, okay, and I duplicate this trade one more time, okay, and now I show you that the 260 call now belongs to June 18, and we now input that our $689 of risk that we had are now diminished by 195, which is the new credit we collected. So that is now pushing down the risk of this trade to be 4, did I say 89? Let me do that. 494. I'm not sure why I came up with 89. Okay, so 494. Okay, so in other words, if I kill the first row and I leave my new double calendar after doing those two rolls, we are now in a position where the most I can lose is 494. Why? Because that's what you pay for it, 494. I locked in on $91.50. Let me rephrase that. I didn't lock in. Okay, this is the current real-time P&L of the trade. We didn't lock in. Remember, if the market was to move, we can lose up to 494. Okay, so we didn't lock in any profit, but we are working on evolving this trade to a point where we will end up risk-free if we continue doing that, and where the most we can make now is 400 something. Okay, with a very wide range, with a positive theta, which of course now after the roll is 13 instead of 35. But remember, the theta we saw here before was distorted because the 260 call was distorted, as well as the 230 put were distorted both before we did the roll. Okay, so what we see now is now accurate. Okay, and we are back into another action to keep improving this trade. Okay, and Maca, you got filled at 2. That's great. You got a good price there, better than 195. This is fantastic. Fairmont, Abnu, how are you guys? It's good to see you, my friends. Thank you for the feedback there, and also again, done with the management of this trade with PayPal, and therefore it's now time to move into AMD, which is the next one in the list. Okay, so let's take a look at AMD, and this is a lot of tweaks, but this is the beauty of options. Okay, so in one hand it's a bit confusing, on the other hand, this is why we have so much fun trading options, isn't it? And also not only the fun really, but the tremendous advantage that it gives us, okay, when it comes to being profitable. So AMD, as you can see, is also a trade which is a double calendar. We got 18 of June and we got 16 of July. So remember, if you remember from the prior weeks, when we did the rolls, we had to go all the way to June 18, given the very little premium available on June 11. Okay, so we had to go that far. So the current values are 6.5 cents, and 27. So I'm pretty positive we're gonna have distorted Greeks. The question is, will I have premium enough to do the roll, or will it be just better to do nothing at all? Okay, and just leave it like that. Joanne, I know you are having fun with options. I see that smiley face there. That is the hint that you gave me. Anyway, so going back to the chart, so we are currently trading at 80. So let's take a look at where we're at. So this trade is currently showing a negative 16.5 P&L. On TOS, it shows negative 20. Okay, well, if you add the prior tweaks, the prior rolls that we did all together, overall, it's actually minus 17. So it's about the same in this case. When it comes to distorted Greeks, okay, so we'll start with the put side. We are using 70 puts. So the 70 puts, okay, the 70 puts have extrinsic value of 7 with a theta of 2. So 2 times 9, that's kind of like 18. But we only got 7, so those Greeks are distorted, okay? But the question is, if I go to the next one, I'm gonna have the same problem or not, and I do have the same problem. because extrinsic value is 11, and if you take at theta of 2 times 16, that would be 32, okay, but we only got 11. And if you look at, I'm just gonna go all the way to July 9. So extrinsic is 27, theta is 2, 2 times 30 is 60. So again, distorted Greeks. So we have distorted Greeks all over, just like what we saw the other day, at least on the put side. So we're gonna do nothing and let that option expire, okay? And on Monday 21st of June, then we'll sell it again, okay? And then we got the 85 call, okay, 85 call, which pretty positive. If we look at the call side, we're gonna have distorted Greeks. So extrinsic value is 27, theta is 5, okay? So 5 times 9, it's 45, isn't it? 45 is more than 27, so we have distorted Greeks. But they are less distorted than the put side, so maybe we can do something about... so we got June, this is 26, okay, 85 call. Let me see, 85 call on the next expiration date. We got theta is 4, extrinsic is 49. So 4 times 16 is, 60 something, and we only got 49. So yeah, so nothing to be done with AMD. Okay, we got distorted Greeks all over the place, and this is because when we did the trade, so there was more premium available. Remember, we entered those trades because of that arbitrage opportunity, so there was more premium available on the front week, but then it didn't translate until the other expiration dates, and therefore, since volatility is not rising yet, so we're gonna play the patience game. And remember what we said, it's not worth it to roll because you may get a bit more credit, even though the Greeks are distorted, but then it's gonna be just a little bit more credit and you have to pay commissions, which make it not worth it. So we are likely gonna leave it alone until June 18, and then on the Monday after, this is the time where we will be reselling options one more time. Okay, so we'll discuss that when the time is right. And finally, we got Lily. Okay, so Lily is a trade where we may need to act on it. Okay, so Lily is a directional trade that we put together the other day. So we got into this trade when Lily was trading at 200. Lily is currently trading at 224. Okay, so this is a spectacular move, to be honest. Okay, this is not a move that we see every day. So this is about, from here to here, it's kind of like, I would say 12% or something like that, right? 11.5%, something like that. So it's a pretty nice one, okay? And it's a nice one to have in the account. Hopefully you guys are in the trade. This one is $465 up per contract, okay? And remember, this is a trade that we did by selling the 180, buying the 175, and then buying the 230. So in other words, we bought the 230 call for free. Okay, that's what we did. We bought the 230 call for free because it was financed by selling 2 bull put spreads. Okay, so now what happens now? Well, what happens now is that the 2 bull put spreads are in profit. The 230 call is in profit. Okay, so what we could do here, okay, we could see, how can we lock in profits? Okay, because it would be very sad to get that stock, break out. Remember that this is the concept. Okay, and between us, this is a powerful trade. Not all trades are going to be that powerful. Okay, 11.5% in a week in a stock, it's beautiful, right? So it's not always going to be that powerful, but at the same time, this is what we were shooting for, right? We were shooting for a stock that begins making all-time high while the S&P is about or likely going to make all-time high, and have this this power, these forces teaming up. So now all of this has happened, and therefore now what, right? So well, the first thing I would like to do is I would like to evaluate, okay, what to do next, because this trade is a trade that we did for 4 cents of credit. The current price is 466. So again, if you close it now, if you were to close the whole thing, so you would be in a $470 of profit position. Okay, that's great. Okay, but can we do better than that? Because at the same time, if the stock keeps moving higher, there is more money to be made, isn't it? So notice that the more the stock goes, if the stock goes all the way to 250, for example, So this trade is gonna pay close to $2,000, where currently is up for 70. So there is more money to be made if the movement continues. But at the same time, there is the risk of, you know, having made all this profit, enjoy 11.5% move, and then next thing you know, the opposite happens, and the stock. Remember, I told you when something moves fast in one direction, it typically moves fast the opposite direction. So now you give back all that money to the market. So we don't want to do that, isn't it? So let's try to find a way to help this trade to at least lock in some profits, okay, and give it the opportunity to continue. Or maybe as we do this analysis, we conclude it's time to close it and that's it. Okay, so let's give it the opportunity. Okay, so what I'm gonna do is I'm gonna analyze an opposite trade. Okay, meaning that if I do the opposite trade, of course, now I flatten, okay, the trade, and I end up with $465 of profit, because it's entering a simulated trade, which is opposite, is the same as closing the trade. Okay, and what am I gonna do with that? Okay, well, this trade I just entered here. Okay, to be honest, I didn't enter it so I can, evaluate that. I enter it to evaluate what happens if I delete. Yes, with this version of Tradestation Pro I cannot do this. Okay, so let me do this. I'm just gonna enter it manually. Sorry for that, guys. I'm using July 16. So July 16, let me enter on the put side. Let me build it and then I will explain, and you will see how it's easier if I explain it after the fact, because I'm gonna be more visual like that. So we got 180, 175. So we got 180, 175, and it was 2 units. Okay, so let's do 175 and 180. No, this is backwards. Here we go. So yes, so here we go. Take a look at this. If I go ahead, okay, if I go ahead and I buy back the 180 and I sell the 175, okay, again, going back to the chart, just to be visual, we sold the 180, so I'm telling you now, buy it back. We bought the 175 and now telling you sell it and close it. Okay, if you were to do that, basically, if you close those two spreads, okay, if you close those two spreads and you do it at the midpoint, which again, because price moved 11.5%, that's going to be difficult to achieve, because you can see the spread now is huge. Okay, so the spread now is huge, as you can see, but there's no rush. Okay, so you can place an order and just take it very, very easy and try to get that midpoint or close to the midpoint. But the idea is, if you do that, notice that you did this trade for 4 cents. If you were to be able to close it at the midpoint, you would pay 7. So in other words, it's kind of like you give up on 4 and you pay 3 extra. So now you would be left with a call that cost you $3. That would be the net result of closing the puts now. Is that making sense? And because the call would have cost you $3, so what's the most you can lose is 3. Okay? So now you are in a super, super, super powerful position. Okay? So certainly so far it's looking like this could make a lot of sense to go ahead and close the puts. Okay, I'm not done yet. Okay, so closing the puts could make a lot of sense. So that's choice number 1. Now choice number 2. Okay, choice number 2 is the following. So if we look at this particular stock, Lilly, as we know, is making all-time high. Okay, if I look at a weekly time frame, for example, to get a bit more visibility, or even a daily time frame, okay, so we can see that there's been a very strong push, a retracement, and then another push, right? Could this retrace and then push again? Definitely. Should push a bit more actually on the daily time frame, because it's 5 out of 9. So at least for another 4 days, it could keep going. Okay, but what's the issue? What is it that I have in the back of my mind that is creating a feel of risk? Okay, and giving back those 11.5%, that move that we enjoyed. Well, what I have in the back of my mind, what about you answer? What do you think I'm seeing, or I'm thinking that may be a risky thing if I do nothing about it? Because it's looking healthy to continue, but there is something that I cannot stop thinking that may be the reason why it's not going to keep going. You guys tell me, what do you think that may be? Okay, I'm gonna give you a little bit of time. Again, we have the video lag and all of these things. So I'll give you just a little bit of time so you guys can answer. But I would love you to say it instead of I said. Exactly, Mark. Exactly. Very well said. Exactly. Yes, and you're right, Christian, as well. So there is plenty of, fundamental, reasons why certain things may or may not happen. Which, to be honest, that would, while that's a very valid point, Christian, it's not so much of a concern because, remember, if the stock was to drop so much, let's say that FDA approval is not approved or whatever, and the stock was to drop so much all the way to 180 from 223, I mean, now you're going to get the stock put to you with puts below that protect it from you maximum risking $1,000, which is the risk of this trade, as you probably remember. So, in other words, I'm not that concerned about that, okay? What really concerns me the most is that the whole reason why we got in is that this thing starts making all-time high and keep going. So because the S&P didn't have a pause and started making all-time high and that stock skyrocketed, so being sustainable this way, it's really not that likely any longer. Is that making sense? So I want to explore ways on how to at least lock in some profits, and because it's making all-time high, there's not much I can do when it comes to predicting where a good target would be. So the way I'm going to do it, I'm just going to use Fib projections, okay? And that way, at least, we're going to be able to estimate where that market may go, okay? So notice that I just selected the bottom of this candle all the way to the top and then back to where the retracement took place. And notice that here it says 233 point something. And if I was to zoom in, almost magically, it went there and turned at that price level, okay? Well, when I say almost magically, it's just to create a little bit of, drama in this statement, if you wish. Because obviously it's not magic, computers and many professional traders are using those values, okay, as ways on how to select a valid target. So now another important level is 212, okay? We don't have UFOs there or anything like that, but those two levels are being watched by people, as you can see, because as we are stepping into all-time high territory, you cannot do that much magic to know where the price is going to stop. You can only do projections, extensions, predictions, and using this method at least give you some reference which is objective instead of having a guess. I think it's going to 250, I think it's going to 270. Just like when people say, I think that the Bitcoin will reach 100,000. So why 100,000? Why not 101,000? Why not 150,000? So again, and I'm maybe there is a reason behind that which I don't know, and then it's my bad. But at the same time, in my decision, I like to be mechanical. Okay, so this is a little trick, if you wish. Not that I have invented this trick, but certainly a way that is mechanical and valid enough. So this is now important, and I could not really prepare those targets before because I didn't have the push. Okay, price never went above this high, so I never knew this was the bottom. Is that making sense? But now the price went above that high, so I got my, if I was a classical ABC trader, here is your ABC pattern, right? So thanks to that, now I know 233 is a relevant point, 212 is a relevant point. With those two numbers in mind, I want to go find July 16 and take a look at 230 something and 210 something, 212 something, which we don't have 212, we have 210. We don't have 230 something, we have 230. Okay? So take a look at those values and look at what happens. If I was to sell the 230 call now, okay, what would happen to this trade? Well, let's simulate it. So analyze and sell, single. I'll come back to this in a minute. If I was to sell the 210 call, what would happen now? So let's do the same. Analyze and sell, single. Okay? And now let's go back to my simulation tool. Let me uncheck everything I got below, and then I will be rechecking one at a time so you fully understand what we've got. So let me go back to the chart. So one of the things I am considering to add to my trade is to sell the 230 call against the 230 call I have. Can I do that? Yes, but that's equivalent to closing the trade, isn't it? That would be equivalent to closing the trade. Why? Because you bought the 230 call. So if you sell it and it's the same expiration date, that is equivalent to closing the trade. Okay. So option number one, close the trade. How does that look like? Looks like that. Like this. So you just flatten the curve, okay, and you just made 467.5. So you have the original trade in place. You get rid of the put spreads, which are 2. Okay, this is number 2 right here, right? And then you sell the 230 call, which is close the 230 call you bought at the beginning. So in other words, you flatten the position, you're out, you close the whole thing, and then you're out for the current P&L, which is 467.5. So that's one option. Of course, I'm not super happy about that because I just told you that I'm looking for a way to give this trade another chance to make more money for me while I manage the risk, and I don't want to give up, that 11.5% move. So what else can I do? Well, I could try the 240 call, which is above the target, which I may or I may not get there. It's a bit less likely to get there, but that one will pay me some decent premium and should offset nicely the risk of the trade. By the way, why 240? Because there is nothing between 230 and 240. So I wish there was 235 or something like that. It doesn't exist, so I need to go for 240. The 240 is going to pay me $200, 230. Okay, so if I do analyze that, it will look like this. Okay, so instead of 230, I'm going to do 240. Okay, and there is a bug in TradeStation. Notice that it doesn't change it. So I need to quickly change the quantity, and then when I compress, now it changes it. Okay, so you got 240. Okay, so what happens if you do this trade? Okay, so you have the original trade, you close the puts, and then you sell the 240 call. What happens to this trade? Well, what happens to this trade is that now the most you will lose, it's nothing, because you are in the positive. Worst case, you'll make 229. So notice that by doing this action, by selling the call now, you could also diagonalize it, okay? But that has other implications that I would like to discuss. So I'll do that in a minute, Joe. Also, remember, well, I'll go back to that in a minute, Joe. That's a good thought, but let me complete this conversation first, because it's, everything got pros and cons at this stage, okay? So we need to assess that. So if you were to do this, okay, so now you are locking in $222 of profit. No matter what, even if the stock goes bankrupt, you're going to make that, okay? But you are giving the stock now the opportunity to make up to 1,229 as long as it goes above 240, okay? If it goes anywhere in between, it's going to be anywhere in between 229 and 1,229. This is what you're gonna make. So in other words, you are locking in a profit. No matter what, you cannot lose anything. The most you would, the worst case scenario is to make 229, but now you are giving the trade a chance to make $1,200. Okay, so that it's an action that I would see as quite smart. Okay, so this is probably a good one to do. Also, what if I don't close the puts? Or let's say you are trying to get the puts out, but you struggle to get the puts out, okay? Because you're not getting the midpoint, and you try again tomorrow, and you try again next week, and you are not getting filled on the puts. Well, I uncheck the puts and notice what happened. So your risk profile now it's minus 757. In other words, if you don't sell the call, you remember, I'm sure, that the most you can lose in this trade is 1,000. So if you sell the call now the most you would lose is 1,000 minus 200 plus, which is 750. So by selling the call now, you remove risk. If the stock drops, you are locking in those $200+, and if the stock goes higher, you are still gonna make your 1,200. So definitely the way to do this, okay, if you want to end up with closing the puts and selling the call, it's start selling the call as soon as you can, and then work on getting those puts for the best prices possible, ideally 7 cents. Let's say you don't get filled at 7 cents, and let's say you get filled at 25 cents. right? Let's say with the calls, the liquidity is good on the calls, but let's say you got feel that, let's say 200 instead of 242. Well, guess what? You're still locking in $154 of profit, and if you're right, you're gonna make 1,154. So the problems with liquidity, of course, is not ideal, but it's not like it's gonna be a major issue. So I would start selling the 240 call, get the most you can from the call. That reduces the risk the most you can, and then focus on trying to get rid of the put spread at the best price as possible, and be patient. And if you don't do it today, do it tomorrow, next week. As long as you do it at some point, then it's fine. Good. What else? The other option is to go ahead and to sell the 210. So what happens if you sell the 210? Okay. Well, if you sell the 210, okay, and the stock falls, okay, think about it. So if instead of selling the 240, I sell the 210, which is somewhere here, okay, so if I sell the 210, okay, and the stock falls, I'm going to have to deliver the stock at 210, and I have purchased the stock at 230. So you're going to lose $20 on that. So guaranteed you lose $20. But in exchange for losing $20, you are collecting $16.43 of credit. Right? So in other words, these together, with everything you've got on the trade already, would make it very nice if that stock falls. Because now if the stock falls, okay, you're gonna make 1,600. If it falls even more, then you're gonna make less. Okay, but the problem is if the stock rallies. That's the problem. Okay, that is the problem. Okay, and this is true even if you close the puts. If you close the puts, then the more it falls, the more you make. Okay, as you can see, which is 1,600. There is no that indent, if you wish, that we can see here if I disable the puts. Okay, but again, the problem, no matter if I close the puts or not, is what if the stock goes higher? So if the stock goes higher, now you would lose 367. So in other words, the 210 call is just a bit too low. So what happens if instead of the 210 call, I was to sell the 220 call? Okay, and notice that it's not going to be a good choice, because if I do that, I'm going to lose very little, 66. I'm going to lose very little here, 66. Okay, I'm going to make 900 if I stay between 175 and 230. But if the stock was to rally hard, instead of making money, I will end up actually losing 66. So in other words, the fact that we only have $10 strike price increments in this particular case doesn't allow me for too much choice, and therefore the 210 or the 220 are not a good choice at all, and therefore the right action to take here is to go ahead and sell the 240 call, okay, which I'm going to do right now, and then I'm going to be working on closing those puts. Okay, so I'm going to do that right now, and then I will answer Joe's question, and I believe that this will bring us to the end of the session. Okay, so again, the choice is we are selling the 240 call. Okay, we're going to sell the 240 call to lock in those $200 over of profit and let that stock to make 5 times more for us if it keeps going higher. So so here is Lily, okay, and so let me do this to make it very quickly. So I'm just gonna create, no, okay, let's do it from here. So we are looking at Lily. We are looking at July 16. We are looking at the 240 call. Here we go. We are going to be selling a single call. Okay. This will collect 230 for us. Okay. So I'm just going to make it a bit more pessimistic just so I get filled quickly, especially we are about to hit the top of the hour, so we need to conclude the session. So I am selling the 240 call, send. Okay, so hopefully I get filled quick. And then the other thing I want to do, I just got filled. I got filled at 239. Okay, I got filled at 239 for that one. So let me update that on TradeStation. So we got 239 for this one. And then I'm going to work on closing the put spread. Create a closing order. I'm willing to pay up to 10. Let's see what I get. Again, remember with a simulated account, it's probably going to be an optimistic price what I get. So we will see. Wow, extremely optimistic, I would say. Yeah, I think I got 10, right? No, I got 4. Yeah, I got 4. That's it's not gonna happen in the real world. Okay, you're gonna have to pay more for that. Okay, but anyway, so I will document it the way I have it because this is what I have it. I mean, the mean point is 7, so I cannot get 4. I'm just gonna document it as 7. Okay, you know what? I'll make it 10, just to be a bit pessimistic here. Okay, again, you guys work on that with no rush. Okay, so in other words, with those 2 trades executed, what did I have now? Well, a trade where worst case I'm gonna make 223. Okay, and best case I'm gonna make 1,223. That's the trade that we have now, and this is how we have taken advantage of this all-time high situation that we put together with Lily last week. Okay, so now we are here, you know, on that position with $400 of profit there, and again we know worst case is gonna be 200, best case 1,200. So I guess you guys are working on this. Before we go, I wanted to answer Joe's question. The idea on this trade really is, first of all, it's to give yourself the opportunity to exploit an all-time high situation, knowing that normally you have an initial very strong push, but this is normally followed by either continuation or a complete disappointment and a complete change of trend. Right? More often than not, it's continuation, especially when you think about what the S&P is doing overall for years. Most of the stocks follow. So in other words, we want to position ourselves for that. If you diagonalize it, so the problem that you're gonna have is 2 problems. Number one, you may get a sign, and then you end up yourself being short stock. Okay. Which again is not a problem because you own a call, so we talked about it. But from a use of capital point of view, it is a problem because you are exposing yourself to this trade until July 16. Okay, so it's not like when we do the double calendars where you would be rolling quickly and things like that. Then you have less choices, okay, less possibilities because you know that's it. You got a sign. You can go ahead and the next Monday close the whole thing and that's it. But you would then make less money. Okay, but the other reason why is because you know when you are positive delta, when you are shooting for a positive trade, a trade that moves to the upside, what happens typically is that when the stocks go up, volatility goes down, and what's going to happen is that when you are using a trade which is a diagonal spread, you're going to end up with a lot of positive vega, meaning that as the market is going higher, okay, you are not going to make money as fast as you expect because the drop of volatility is going to hurt the position given its negative vega. So in a case like that, to be honest, I would just keep it simple the way I did instead of, you know, trying to make it too complicated because remember, we decided July 16 last week. We decided to give the stock a chance to break out and keep going. It did. The breakout allows us to tweak it now to a point where now the worst case is to make 200. Now let the stock do its thing and let's see if we're gonna reach that mark of 1,200. And I think that's a much simpler approach, and less tweaking in this case is better. The other comment I would like to add, Joe and everyone as well, is that when you are in a directional trade, the Greek that is gonna pay you the most, okay, the way you make money is delta. So it's the directional movement is what pays you the most when you are in a directional trade, which is the case. So tweaking too much, rolling too much, your order to close the puts get rejected. That's interesting. You may need to talk to your broker, Maca. That doesn't make sense because you would be left with a long call or a call spread. And that, no matter the account that you use, you should be allowed to do that. So you may want to connect with your broker on the chat or something like that and clarify why is that happening, okay? Maybe you made a mistake with the plus and the minus sign. Review it carefully. Sometimes it's a silly thing like that. It happens to all of us, okay? In any case, coming back to the question about diagonalizing, remember, in the case of directional trades, the way you make money is your deltas. Okay, it's if you pick direction, you make more money than no matter what else. Because we pick direction, and the purpose of this trade is to pick direction, let's do that. In other cases, like for example, the double calendars that we do, or the iron condors, or other trades that we'll do as well. So what are we playing? We are playing other things. We are playing staying in a range. We are playing Vega. We are playing time decay, theta. So we are playing all of those things. So in those cases, it makes sense to, scratch a little bit of profitability from here, scratch a little bit of profitability from there by diagonalizing, tweaking, rolling, and doing all those things we do, because that's how those trades pay you. You stay in them for a long time and you keep taking advantage of little pieces here and there. But in this case, it's not the case. In this case, we are exposed to direction, given the fact that we own positive deltas and positive gammas. And therefore, you want to let the trade to profit for you this way. Everything else you do to try to kind of like be smart in a way of trying to be more efficient, it's going to penalize the delta. Like if you diagonalize it, you will end up with negative gamma, for example. So negative gamma will penalize the delta, which is what pays you the most. And on top of that, you end up with a wrong vega for a trade that moves higher. So again, there are times where trading options, it's worth it to make it a bit more complex because it pays you better. But there are times in trading options where a simple action, in this case of spreading your call by selling the 240 against the 230, that action is actually simple and smarter than overcomplicating your steps, even though your thought is very logical and a very good thought. But all the reasons I gave you hopefully makes you understand why I would not be keen to go that route in this case, because it's directional. No stop order, Joe. You know that even if the stock goes bankrupt, so you will be assigned an exercise. Let me rephrase that. You will, if the stock goes bankrupt all the way to zero, both calls will expire worthless because you have collected a net credit of 223. That's the net credit, okay, which is 239 minus 10 plus 4, okay, that's 223, okay. So because you are in that position, so if everything expired worthless, but you collected $223 of credit, so that is what you're gonna make, and that's it. Now, using a stop loss order would have no implications on the order being rejected or not. Having the order to be rejected is either an error in the system or an error with order placement, or a margin implication, or an account permission type, because with options you have options approval levels. But in this case, selling the call against the call you own is going to reduce the cost basis, so margin is not a problem. Doing a spread is limited risk, and therefore account permissions is not a problem. So I could not see why you get a rejected order. Okay, so you will need to talk to the broker. There is no reason why you will get a rejected order. Anyway, everybody, I surpassed the time by 8 minutes. Hopefully you guys are okay with that. A pleasure as always, guys, to join you and to spend a little bit of time with you. Lots of management today because we had multiple trades in the account, so we had to talk about it and do things. Good news, we don't have to do much tomorrow with trades that we already have. So then tomorrow is going to be more about finding trades and executing. So see you again tomorrow, same place, same time. You guys take care, and thank you for the feedback. You are long, Fairmont. You are long with a long. You are long a call and short a call. Okay, so you have a call spread. you are still owning the 230 call and owning the 240 call short. Okay, the ones we got rid of are those two. Okay, these we got rid of, we don't have them anymore. So we have a call spread 230, 240. Very nice, everybody. You guys take care, my friends. As said, see you tomorrow, same place, same time. Take care, everybody. Bye bye. Keep up the good work.